Hello, this is Chuck Carnevale. I'm the Chuck in the Markets Up Chuck. And over the weekend, I published an article in Seeking Alpha that talked about why you shouldn't worry about a stock market crash. And of course, I received a bunch of comments and a lot of people who were quite even upset about what I wrote. But the point I want to make is what I was really doing was trying to do a couple of things. First of all, try to talk about some optimism where, I believe there's so much pessimism is pervasive today. And I believe that the problems that we've faced here recently and are still facing are real. They exist, but I also think that they're solvable, and I think we live in the greatest country in the world. And I think problems and challenges are there to be solved. But I do believe that the best way to solve a problem is to approach it with confidence and faith and an enthusiastic attitude. I believe, becoming fearful and avoiding markets can end up being self-fulfilling prophecy. But, of course, a lot of people disagree with that process. A lot of people are angry at what happened to their 401k plans and so on that were commenting on the article, and I'm definitely very sympathetic to that. There's nothing about what happened do I like, and there's also a lot of talk about Wall Street. I think Wall Street, to a great extent, was much to blame, but I also think our own government was much to blame. But having said all that, the reality and the point of the article was that this whole idea of forecasting the stock market to me is folly. I believe that it's a market of stocks, not a stock market. I believe that it's the individual holdings that you own that are most important. And so I did some work and I covered some companies, and I'm going to go over them here very quickly for sake of your time. But the point I want to make is, first of all, there's a lot of talk about the lost decade, the market, and that's obviously true. When you look at the S&P 500 going back to calendar year 2000 or the last decade, which is just 1 month short of 10 years now. The reality of it is a $100,000 investment in the stock market would have only turned into $74,000. So for 10 years, the average rate of return in the S&P 500, the quote-unquote stock market, which I used as the proxy for the stock market, was a minus 3% a year compounded. You actually lost money holding stocks for 10 years. That's obviously no way to build up retirement or provide for your long-term financial security. But the culprits, I think, were, first of all, you're dealing with a period where in calendar year 2000 you had this irrational exuberance which kind of came to a peak in 2000, and then you had a stock market collapse based on overvaluation. And the real culprit here was overvaluation, was market prices that were too good, not that they were too bad. And then of course that caused this big reversion to the mean. But then we did have a nice period here in the middle where the stock prices did real well. Had you been buying at this point, obviously you'd have been well. Of course, if you'd been buying stocks back up here when the market was around 1500 in September of 2000, you still wouldn't have been doing too well, by into 7 years later. And then of course, as the market fell to 1,000, it's even worse. But the point is, the real culprits here are overvaluation and poor economics, tied into that. But the real reality here was it was irrational exuberance that caused most of this melees back then. Another point that I was trying to make with all this was that this represents 500 companies. Some are good, some are bad, some are okay. Some are awful. They come in all flavors and all kinds. Even with this small universe of 500, you got to realize that in the real stock market there are thousands of companies, and they all are individual companies. And that was really the focus of my article, was to point out that when you look at individual companies, what's going on in the general stock market really shouldn't matter. What you really should care about is the individual companies you own. So I showed some examples. Let's look at it kind of like Cognizant Technology. And here's a point I want to make is this company's stock price fell precipitously during the market crash of 2008. But in 2009, you can see it's obviously recovered very, very nicely, because what's happened here, the earnings of this company have continued to be good. Now, when I say don't worry about it, I think it's if you know your business and you see the price dropping like this and yet your fundamentals are good, you don't worry about that, because you know that you've got a great company with little debt and generates strong cash and is continuing to do well in the business. And that's my point. The point I was trying to make was, as an owner of Cognizant, I was never too worried about what the market was doing, and I wasn't even too worried about the fact that its price was falling, because I was very confident that this was a terrific long-term company. And when you look at it from a track record point of view, even after it went through the drop in the market, and of course now the subsequent recovery or partial recovery, $100,000 in this stock would have grown to $959,999. That's a 25.7% compounded annual rate of return. There's no lost decade owning Cognizant in a market where that would have obviously lost you a minus 3.9%. 3% compounded. Clearly, you know, what was going on in the market was not as important to Cognizant shareholders as what was going on in the company. In the long run, it's the company. Here's ITT Educational. This company actually saw earnings accelerate throughout the recession. This company is technical education, and yes, people were unemployed, which is awful. I fully agree with that. People were flocking to ITT to better themselves and to learn more. And of course, this actual company has been recently maligned by various portions of the media, and I find it laughable. Actually, one man actually had the audacity to say this people was preying on people's dreams, and to me that's ridiculous. Getting a good education at any level is always a positive thing, at least in my view. But here again, here's another company whose stock price did drop, but yet the business did well. And as an owner of this company, unless I was planning on selling it that very day, I'm not too concerned, because once again, you have a company that generated a 28.5% rate of return for its shareholders during a period when the market was actually losing money. So, the individual companies themselves did well during this decade. Here's Nike, which is a kind of a stalwart, has a nice dividend, 1.6%, very well-known company. You can see they've had very consistent earnings growth. Their stock price did fall, but they also rallied back to normal valuations very, very quickly. And once again, the market itself had very little to do with Nike over the last 10 years. This is a much more conservative company than the other two. And again, I mentioned the stalwart does pay a nice dividend, has a nice record of increasing its dividend, and you'd have made about 10% a year compounded, not counting dividends. I'm only looking at appreciation in this presentation, again, in a market that lost money. Coach is another very aggressive growth stock, and it had a horrible stock price reaction during this market malaise, but the earnings of the company held up very well, and the company's recovering. But again, because of the fast growth of this company, they actually generated a 31% compounded rate of return. Now, a slightly different time frame here, because they weren't public for the whole 11 years, but we're only missing a few months here. But the bottom line is, during a period where the market lost approximately 3% a year compounded, Coach shareholders were earning over 31%. So again, it's a market of stocks, not a stock market. Google, Google wasn't even in business at the beginning of the decade. It didn't really go public till 2004, but had just unbelievable growth and has become a ubiquitous name and a ubiquitous concept now. Keep in mind, this company didn't even exist 7 or 8 years ago, and who knows what's in store for us in the future. I believe in being optimistic, as I said earlier, but here's a company averaging 38.9, almost 39% a year compounded during the period where the market was actually losing money. So the point is, it's not the market, it's the individual companies you own. Then I showed Oracle and Procter & Gamble for a reason. I wanted to point out that Oracle actually did very well as an operating business during this period, but due to the irrational exuberance, especially in tech, that was going on in 2000, the stock was massively overpriced during that year. It was actually overpriced in the beginning of the year and got worse towards the end of the year, as you can see, or almost doubled in value during that period of time before it ultimately came down in class. But when you look at this company and compare it to the stock market, you'll see that the losses in Oracle were similar to the losses in the market, but again, not because of the stock market. Well, in the way you could say it was because of the market. Oracle was massively overpriced in the beginning, and then, of course, over time, its stock price reverted to the mean, and it ended up being a lost decade if you owned Oracle. And Procter & Gamble, a very stalwart company that was just overvalued during 2000. It started the period overvalued, but it had good earnings growth, almost 10%, 9.5% a year, pays a very nice dividend, has a great history of increasing its dividend, and yet, you would have only made about 1% a year in appreciation versus a market that lost 3%, but that was based on overvaluation. It wasn't the stock market, other than the fact that it was overvaluating Procter & Gamble at the beginning. Now, this is Chuck Harmel. I hope this gave you some extra insights into investing in the quote-unquote stock market, or I like to say investing in individual operating businesses. I believe in doing your homework. I believe in researching each company thoroughly, and knowing the value of what you actually own is the way to to control your fears. If your company's doing well and you have great confidence in your company, then what the market's doing isn't really important, as long as you don't react to that and do something foolish like sell or buy, for that matter, at the wrong time. This is Chuck Harmel saying thanks for listening. Talk to you again tomorrow.